Welcome to Spreadsheet Geek. In this video, we're going to talk about growth companies. Often there's an expectation that growth companies will grow their earnings faster than their sales. How is this possible and what's the theory behind it? This video was made using Microsoft Excel 2019. I think the easiest way to discuss this topic is to talk about an income statement. This is a generic income statement. At the top, you'll see the revenue section. We've got sales revenue of $500,000. This particular company has an other revenue section, which I would assume is that they're selling something that's not part of their core business, but it's zero, so we'll overlook that. Below that, we have sales returns and allowances. Sales returns are when customers return product for one reason or another, and allowances are typically discounts granted by the seller because of defective product or the incorrectly filled product or something of that nature. Sales revenue less these returns and allowances gets you to what is expressed here as total revenues, but it's often cited as net revenues. When people refer to a company's top line, they're talking about net revenues. Immediately below the revenue section of any income statement will always appear a cost of goods sold or cost of sales section. It's in this section that costs we can directly link to the sales are expressed. For a manufacturer, this may be the materials and the labor that go directly into the product, not the labor of the people working in the front office, but the people working on the assembly line. For a reseller of goods, this may be the cost of the inventory and bringing that inventory in to resell it. For a service provider, it will be costs that are directly going into providing that service. Cost of goods sold or cost of sales, which are synonymous terms, these costs are often referred to as variable costs. This is not because the costs vary with the price of labor or the price of materials. It's because they vary with sales. The greater the sales level, the greater the cost of goods sold. It's a direct relationship. When people talk about the variable costs of a business, they are talking about those costs which vary directly with sales. If you take net sales of the business, in this case $500,000, and subtract that cost of goods sold, $150,000, you get to gross profit or $350,000. The gross profit margin is equal to the gross profit, $350,000, divided by the sales revenue of $500,000. In this case, the gross profit margin would be 70%. Gross profit margin is kind of synonymous with contribution margin. Although when you're talking about contribution margin, you're usually talking about an individual product. If we produce widget A on our assembly line and we sell it for $1 and it costs 50 cents to make that product, that contribution margin would be 50%. But it's also a gross profit margin for that product. We'll come back to contribution margin later, but next I'd like to talk about this big section of expenses on the income statement. This expense section is often referred to as operating expenses or fixed costs. These are costs of the business that do not vary with sales. For example, our accounting fee of $2,500 is going to be our accounting fee regardless of how many sales we have. Advertising may be the same. Depreciation of our equipment would be the same regardless of how many widgets we sell. Now realize that this is not perfect. Some of these fixed costs probably do vary with our production level. For example, utilities cost would be expected to go up the more widgets we produce on our assembly line. And if we're a build to order business, then that would mean that our utilities expense would go up with our cost of goods sold and our sales, making it a direct cost. But we're going to keep it a fixed cost down here in the operating expenses section because it's difficult to link it to sales. This is not a perfect situation. There are some items in the fixed cost section which theoretically we could allocate through some complex allocation system and move it up into cost of goods sold, but we don't because it's not practical. Adding up all of those fixed costs or operating expenses gets you to $258,500, and if you subtract that from the gross profit of $350,000, you get to a net income before taxes and after taxes of $91,500. This net income of $91,500 is what's referred to as the bottom line. The subject of this video is how do companies grow their net income faster than their sales, or in the context of this discussion, grow their bottom line at a faster clip than their top line. In the remainder of this video, we'll look at a theoretical example on a worksheet followed by a real-world example. On this worksheet, I've transferred those numbers from our fictitious company. We have net revenues of $500,000 less cost of sales or variable costs of $150, getting us to a gross profit of $350. I put our fixed costs of $258.5 in there, getting to a net profit of $91.5. And in this cell, I've gone ahead and calculated the gross profit margin or contribution margin by taking that 350 divided by the 500. So that's our fictitious company. Now let's make an assumption that we're a growth company and we can reasonably expect to grow our top line at a clip of 10% a year for the next 5 years. What will that look like? So I've mapped out the next 5 years here, and I've gone ahead and added these cells for my annual sales revenue increase, which will go down into this line, and my cost increases for variable costs. These are the costs that are tied to my sales, and those will go in here. So let's put a formula in here of 1 plus this rate, and I'll fix that cell, and multiply by the previous year's sales. Let's do the same thing with costs. 1 plus this percentage increase, fixed, and then we'll multiply that by the variable costs. And we'll fill those formulas right across. Now I'm going to hold the fixed costs steady at $258.5. We know this is not realistic. Fixed costs like insurance premiums for business insurance go up every year. Some of the other costs, the salaries in the front office, and many of those costs go up. But let's just say for the sake of argument, we were able to hold those at $258.5 for the whole 5 years. This is why businesses can grow their bottom line net profit faster than their top line. The top line here grew from $500,000 up to about $805,000, not even a doubling, while the bottom line more than tripled in this 5-year period. Investors are willing to pay a premium for a growth business like this when they project this kind of growth on the top line and the bottom line and no erosion of margins. Growth companies are considered lower risk investments for this reason. Now let's turn this growth company into a value company. Let's say our annual sales revenue is expected to increase at a low single-digit kind of economic level of 4%. And let's say we face some significant cost increases in labor and materials, and they are going up at 6%. Look at how the picture changes on this. For one thing, we have gross margin eroding at 1% every couple of years. Our sales only go from 500 to 608, but our bottom line only goes from 91 to 150 over a course of 5 years. How the picture has changed from that growth company. This is a value stock. It's a value company, and investors typically award value companies lower multiples. They're higher risk. This company has some issues and some growth problems that make it less attractive as an investment. A lot of managers think of this in terms of how soon during my fiscal year do I generate enough gross profit to cover my fixed costs. And for this company in 2020, it took the better part of a year to generate enough gross profit to cover this 258.5 in fixed costs. So there's a little bit of profit left over. But even in the final year, you've got 407 here. It takes probably around 9 months, 8-9 months of the year to generate 258 in gross profit before you get to this gravy here. And we've got some gross profit margin erosion going on. I'd like to wrap up this video by taking a look at some real numbers for a real growth company, and we'll look at how they were able to grow their bottom line much faster than their top line. These are the financial results for a company called NVIDIA. They make graphics processors for gamers and other applications. And they have a weird fiscal year that ends in January. So this is for the fiscal year ended January 2021. But over the last 6 years, they were able to increase their top line from 5 billion to nearly 17 billion. That's more than threefold. But look at their bottom line. The bottom line operating profit went from 747 million to 4.5 billion. That's more than a 6-fold increase in their bottom line. Notice their fixed costs less than tripled. And their margin for their gross profit margin, which I calculate across here, actually improved from year to year during this period. This is a real world example, and it's not perfect. They did have a painful year that ended in January 2020 where their sales were down and their bottom line was down as well. But overall, it's a pretty rosy picture. This company trades at a very healthy multiple of about 43 times future earnings, according to what Yahoo is telling me right now. I hope you found this video discussing contribution margin, variable costs, and fixed costs interesting and informative, and you understand how a company can grow its earnings faster than its sales. I hope you consider becoming a subscriber. Thank you for visiting Spreadsheet Geek.